So you want to start investing. Well, lucky for you, investing has never been as easy as it is in 2023, although it can still be tough to navigate if you don't know where to look. You've probably seen all these 18-year-olds on TikTok flexing their cash that they got from trading options or investing in crypto.
The guy made $1 million.
I'm sorry to break it to you, but that stuff just simply isn't real. But in this video, we're going to break down the basic principles of investment and how to make sure you're set up for 2023. So if you haven't already, make sure to subscribe. It really helps out the channel as we're just getting started. Now, let's get into it. So you have your pile of cash.
I'm really rich.
And you're wondering, Matt, what do I put it into? Well, before you get to that step, we got to figure out whether it's short-term or long-term. And the way to do this is by using the 5-year rule. The 5-year rule is a way to determine whether your investments are for the short-term or for the long-term. And the reason that's important is because short-term investments are invested differently than something you need in the long-term. The longest downturns in the market tend to last for an average of 3 to 5 years. So the standard rule of thumb is to use 5 years. So just to minimize your risk, the 5-year rule is what we use. Let's break it down with an example. Let's say you know that you're buying a new car for $20,000 in 3 years. That would be classified as short-term because it's under 5 years. For short-term investments, you're looking at things like bonds, GICs, and high-interest savings accounts. Now, while these aren't fun, they can combat inflation partially. High-interest savings accounts and GICs right now are offering about 5% returns, which is pretty good. And if you're sitting there right now with a blank face saying, Matt, what the hell are GICs or high interest savings accounts? Don't worry, I got you with this 30-second walkthrough. High interest savings accounts are offered by all major banks. Some of them have a minimum deposit of say $1,000, $5,000, or $10,000, but a lot of them don't. Tangerine, for example, in Canada is offering a 5% promotion rate for 6 months. GICs, on the other hand, are called guaranteed investment certificates. And what that means is it's basically insured by the government that you will get your full money back. There's two types of GICs. There are cashable and non-cashable. Cashable means that you can cash in the GIC before the maturity date without paying a penalty. A non-cashable GIC obviously just means the opposite. You can't get your money out before the maturity date. Now, GICs range in maturity dates. Some are only 1 month long, some are 6 months, some are 2 years, some are 5 years. So for our example, if I'm going to buy a car for $20,000 in 3 years, I could potentially get a 3-year GIC. However, if I think I might need that money for something else, it might be better to put it into a high interest savings account because then you can pull it out and it's not locked in that GIC. Make sense?
Yep.
All right, now that we covered short term, let's go to the long term. Let's use another example. Let's say we're saving for retirement now, and you have anywhere from 10, 20 to 30 to even 40 years before you retire. You have a lot more time, and that means you can afford more volatility in your portfolio. So with that, you can begin looking at the equity side of things. Equities include stocks, ETFs, and other things. So let's dive into each of them. If you don't know what stocks are, essentially it's your ownership of a company. If Apple issues 100 shares, you own 1 share, you own 1% of the business. There are 2 ways to gain money when investing in stocks. The first is appreciation of the stock, which may occur if they're expected to do well, and the second is dividends. Now, me personally, I'm not a big fan of dividends. I'd rather the company just keep their revenue and invest it into the growth of the company, but that's for you to decide. Now, the best way to describe what ETFs are is basically a collection of stocks. So instead of buying 1 stock in Tesla, 1 stock in Apple, 1 in Microsoft, you're able to buy an ETF which owns hundreds to thousands of companies at once for a fraction of the price. There are thousands of ETFs to choose from, and they're usually divided by either geography or market cap. You can also choose ETFs that are for specific sectors like energy or finance. There's basically an ETF for anything you could imagine. For myself personally, I only invest in ETFs. I just don't see the benefit of owning individual stocks. Single stocks usually aren't the way to go. Now, if your portfolio is large enough, you can look at diversifying into things like dividend stocks, value stocks, or growth stock, or are dedicating a lot of time to actively trading. But for the average investor, it's just not worth it. It makes a lot more sense to put your money into a broad fund where you get all of the gains of the market and also minimize your downside. ETFs are totally passive and hands-off and allow you to diversify over the entire market. There are other options for long-term investing like mutual funds or time-dated funds, but personally, I don't see any advantages to those over ETFs, so that's all I'm going to focus on for now. My personal strategy in 2023 has been to buy GICs with my short-term investment funds and ETFs ETFs for my long term. When it comes to investing in 2023, you can't really go wrong with ETFs. And if you don't believe me, take it from Warren Buffett, whose only advice for this year was to just continue investing in index funds. You hear all these rumors of a recession coming, and then some people think that the market is going to skyrocket. But none of these people really know what's going to happen, so the best way to prepare yourself is just to continue dollar cost averaging into whatever you were before. If you don't know what dollar cost averaging is, it's basically a strategy to continuously buy an asset over a period of time. So for example, every month you set aside $200 and buy an ETF, and you keep doing this no matter the price it's at. Now there are other avenues that you can look at into investing, such as real estate, cryptocurrency, or anything else. However, for the beginner investor, it's important to just get your feet wet and take a hands-off approach.
Safe and sound.
So now that you know your time horizon and what you want to invest in, you have to now figure out how to actually buy them. And there's a couple different options. Almost every big bank has their individual brokerage accounts. For example, I know TD because I use them, they have their own brokerage accounts. A lot of people tend to stick to their major bank because it simplifies everything and it all remains in one spot. However, I would advise against that. For Canadians, there's Questrade and Wealthsimple, and for US citizens, I know there's Robinhood. These platforms all tend to have lower fees. It may not seem like much, but their fees can really eat away at your potential gains. For me personally in Canada, I use Questrade and their fees are very low. As I said, investing is so easy nowadays. All you have to do is open an app on your phone, type in the ticker symbol, and click buy. One thing you will notice is that there's a lot of choices between the accounts you can open. For example, Canadians have a TFSA or an RRSP that they can open, and in the US you have a 401k or a Roth IRA. All of these accounts have various use cases, and it's important to research which one is best for you. I'll be sure to make a video soon about all the different accounts and all the pros and cons, so make sure you're subscribed to me so you can keep up. And just like that, you have completed the beginner's guide to investing in 2023. If you have any questions about any of the content, let me know in the comments and I'll make sure to get to it. And if you haven't already, make sure to subscribe and keep up with all the future content.